Okay, so this is an example of long-term contract accounting. We're going to be comparing the percentage of completion versus the completed contract methods. And let's first take a look at this and sort of compare these. The first thing I want to do is say, well, when do you apply with one or the other? And let's take a look at this. We can recognize revenue over time. In other words, for a long-term contract, that means percentage of completion if at least one of the following three criteria is met. Number one, the customer simultaneously receives and consumes the benefits of the seller's performance as the seller performs. So this is a long-term note receivable or rent on an apartment, those kinds of things where an insurance contract where the customer is receiving a benefit across time, and that's pretty straightforward, and most people understand that going pretty by now. The second one is the company's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. This is one where if it's a long-term construction type contract, typically the customer does not control it because it's in the hands of the contractor. And so that one is not likely to be met in a long-term construction situation. Number 3 says the company's performance does not create an asset with an alternative use. For example, the asset cannot be used by another customer. And in this is the case where a particular aircraft that's being built by Boeing, for example, is dedicated to a specific customer and meets their specifications. In addition to this alternative use element, at least one of the following criteria must be met. So one of these two criteria. Letter A says another company would not need to substantially reperform the work the company has completed to date if that other company were to fulfill the remaining obligation to the customer. Well, with a long-term construction contract of a very technical thing like, for example, a Boeing aircraft, it's unlikely that somebody else could just step in there without having to go back. In this world that we live in, we've got Airbus and Boeing, and it's unlikely that Airbus could step into an airplane that's 40% done by Boeing and complete it without having to go back and do the first 40%. So that's one criteria. The second one is the company has a right to payment for its performance completed to date, and it expects to fulfill the contract as promised. So typically, there are progress billings, and the company expects to get paid on those. For example, if you're building airplanes by Boeing, they expect to get some payments along the way. So these are the situations. Now, if those are not met, then you must move to a completed contract situation. And let's just assume that we have met those criteria, and we're going to go forward with the percentage of completion method. Under the percentage of completion method, we recognize revenue based upon either some external engineer approach, but more commonly, we look at the ratio of cost to date to the most recent estimate of total costs, and that tells us what percentage we are complete. And then we apply that to the estimated total revenue or gross profit, and that'll tell us how much revenue or gross profit should be recognized to date. And then we will then subtract any revenue or gross profit that had been recognized in prior periods in order to determine the current period revenue or gross profit. And so that's the general approach of the percentage of completion method. And now let's take a look and see if we can't get that started. So here, let's take a look at this example. It says on March 1, 2017, Pechstein Construction Company contracted to construct a factory building for Fabric Manufacturing for a total contract price of $8.4 million. The building was completed by October 31, 2019. The annual contract costs incurred, estimated cost to complete, and accumulated billings for Fabric for 17, 18, and 19 are given below. Using the percentage of completion method, these are in the instructions down here, prepare schedules to compute the profit or loss to be recognized as a result of this contract for the years December 31, 2017, 18, and 19. So the first thing we need to do is we need to look and see, well, in 2017, our total contract costs to date were $2.88 million, and our total estimated costs remaining are another $3.520. And what we need to do here is take those costs to date. This is for 2017. Cost to date, and that's $2.88 million, and add the estimated additional costs to complete. $3.52 million. These are all in millions, but we don't need all those zeros because we're just going to do a fraction. I'll add this up. 914, $6.4 million. Total estimated cost at 12/31/17. Next, we're going to figure out the percentage that we're complete is going to be this $2.88 million that we've spent so far divided by the $6.4 million total estimated cost, and I come up with 45%, or 0.45. And we can calculate our revenue, 2017 revenue is going to be 0.45 times the 8.4 million. When I multiply that out, I get 3,780,000. Less 2017 cost, and the 2017 cost is 2,880,000 for a gross profit 2017 of 17 minus 8 is 900,000. Okay, so that's 2017. Now let's go down and let's take a look at what happens in 2018. In 2018, let's use black just to offset it a little bit. 2018, we have cost to date. That's the 2.88 plus the 2.230.23 divided by the total estimated cost, which is going to be the 2.88 plus the 2.23 that we've already incurred, plus the remaining 2.19. And when I do those things, I get $5.11011 divided by 7.3, and that comes up to 70%, or 0.70. And that's our 2018. Now, if we take the revenue recognized in 2018 revenue is going to be 0.70 times the 8.4 million, and let's just make sure I get that right. 0.7 times 8.4. Come on, Jeff, calculator. Equals 5.88 million. And then we're going to subtract revenue previously recognized, and that was this 3.78 million, and that'll give us 2018 revenue. Um, 5.88 minus 3.78, and I get 2.1 million. Less 2018 cost, and that was the 2.23 million. And when we subtract that, we have a gross profit for 2018 of $130,000, and that is a loss, and that's gross loss for 2018. Okay. In 2019, what we're going to do, and let's go back to blue just for an offset for 2019, we're going to say our total revenue, 2019 revenue, is going to be the contract price because we finished it up, less recognized in 2017. That was the 3.78 million. I'll put that in parentheses. And recognized in 2018, that's the 2.1 million. Gives us 2019 revenue. 2019 revenue And when I do that, let me just check. We have 8.4 minus 3.78 minus 2.1, and I come up with 2.520 2019 revenue. Okay? Now, for cost, 2019 cost, is given as 2.190. So 2019 gross profit is going to be 2.52 minus 2.19. I get 330,000. All right. So it says, back to our original requirement here, prepare schedules to compute the profit or loss to be recognized. Let's just say that we're going to recognize profit, gross profit, percentage of completion approach is going to be 900,000 for 2017. It's going to be 130,000 loss for 2018, and it's going to be a 330,000, okay there, 330,000 income for 2019. So that is going to be equal to, if you add those across, 1,100,000 total. Let's back that up. Back that up. Total gross profit, which is, if you add these three numbers across, let's just do that for grins, 2.88 plus 2.23 plus 2.19, that's 7.3 million. And the contract price is 8.4 million. So if you take the 8.4 minus the 7.3 total cost, and that's going to give you the total gross profit of 1.1 million. It's allocated across the 3 years as 900,000 in year 1, 130,000 loss in year 2, and 330,000 income in year 3. Okay? Now, if we were going to use the completed contract method, we don't recognize any revenue or expense in 2017 or 2018, and we recognize the full 1.1 million in 2019 when we complete the project. And there you have an example there. The key is, when do you do this between these two? And let's go back and revisit this. If we were to bring this up, in a long-term construction project, we do it if the performance doesn't create an alternative use that can be used by another customer, and at least one of the following criteria is met. Number one, another contractor can't just step in and complete the project without starting over, substantially starting over. Or number 2, or B here, the company has a right to payment along the way for its performance completed to date. And typically that's how it's handled. So there you have an example of percentage of completion and completed contract accounting.